CNBC just exposed that shorts have been covering. Today I want to talk about which shorts have been covering, how it's impacted the market, and how it's going to continue to impact AMC. So stay tuned and let's make some money. And I want to dive straight in with the key information. So I want to start by talking about what just happened on CNBC and what this actually means. Rockstar Stocks tweeted saying, "Wow, you cannot make this up. CNBC was caught cutting off a guest as soon as she mentioned shorts covering. He said, spread this and let everyone see the evidence for themselves."
Chris and you, I think, are in the camp that you weren't fooled by that summer rally in terms of a new bull. Do you think it's a rally within a bear market?
We thought it was a bear market rally. You look at what really was driving that rally, there were a couple of different things, right? So the first was a lot of short covering. And when you look, there was that concept of, did we actually, was it actually...
I'm sorry, but I've been told we got to go immediately. We've got some issues. Thank you. Squawk on the Street's going to begin straight ahead. Thank you, Chris, and we'll have you back.
So we can see just how shocked this guest was as soon as they were cut off when they started speaking about shorts covering. What she was talking about is the recent rally seen in the S&P 500 over the last weeks, where the S&P 500 rallied from its recent lows up past 4,200 or 420 points. Now this was caused by shorts covering their short positions. Obviously they started by covering their shorts in growth stocks, then they moved to covering their shorts in wider S&P 500 companies, trying all they could to not cover their GameStop and AMC shorts. As the market was rallying higher and as these meme stocks were running up, these shorts were losing billions. Therefore, they had to start closing out of their short positions, freeing up cash to meet their margin requirements. Obviously, they were trying to do absolutely anything they could to avoid covering their AMC and GameStop shorts, because they know if they have to cover and close out of these positions, it will bankrupt their fund, causing a squeeze, potentially crushing the entire of Wall Street. Therefore, that's why these hedge funds started by covering their shorts on growth stocks, then moved on to covering shorts in the S&P 500, desperately trying to avoid covering their shorts in GameStop and AMC. But as Rockstar Stocks tweeted, it seems like CNBC and the rest of the mainstream media and these hedge funds are so scared of any form of shorts covering, they're trying to avoid mentioning it whatsoever. This guest here specifically isn't talking about shorts being covered on AMC and GameStop, but she's talking about shorts being covered in the wider market to avoid covering those shorts in GameStop and AMC. But obviously the mainstream media is trying to avoid any mention of the word shorts and covering, and therefore they're even cutting off guests mid-sentence. Avi Harkishan tweeted saying there's been so much misinformation and FUD regarding how the issuance of APE has killed the squeeze, and that shorts could use it in exchange for AMC to cover their short positions. And he said all of this is nonsense and shorts are in a bad position. So I wanted to touch on what would happen if more APE shares were issued, if these hedge funds bought these additional shares, and if they converted them or were allowed to convert them into AMC shares. Now obviously what many are scared of is if these hedge funds buy up hundreds of millions of APE shares and then try and convert them into AMC shares so they can close out of their short positions. This way they could magically gain hundreds of millions of AMC shares, they won't have to buy AMC in the open market, and they can use these newly created shares to cover their shorts. This is why many hedge funds and shorts are going long APE while they're shorting AMC. In the future, they may be able to convert those APE shares into AMC shares and it'd effectively net down their short position. While that does sound very bad off the bat, I think you have to remember just how many shorts and synthetic shorts actually exist for AMC. Obviously, per the legally reported numbers, there's only 100 million shorted shares of AMC. Therefore, the hedgies would only have to buy 100 million APE shares and they could fully close out of their AMC short position. But obviously, you and I both know there is not 100 million shorted AMC shares. In fact, this number is most likely in the billions. As a result of all these synthetic shorts and synthetic shares that have been created over the last year, over the last 2 years, over the last 5 and 10 years, there's billions of synthetically shorted AMC shares. Now, if the shorts wanted to close out of their billions of synthetically shorted AMC shares, they effectively have to buy up billions of APE shares. Now obviously right now there's only 516 million circulating shares, and therefore these hedge funds would have to do exactly the opposite of what they've done with AMC, and instead of creating synthetic shorts on APE, they'd have to create synthetic longs. They'd have to create and buy hundreds of millions, if not billions, of APE shares in order to convert these to AMC and net down their short positions. Don't forget, one APE share converts to one AMC share. They can't buy one share of APE and convert that into 100 AMC shares. It's a one-for-one conversion. Therefore, these shorts would have to create and they would have to buy up hundreds of millions, if not billions of APE shares in order to convert them and close out of their short positions. Now, obviously, if these hedge funds did buy hundreds of millions, if not billions of APE shares, that alone would push the price up massively and cause the squeeze. There would be very little difference between buying up billions of AMC shares and billions of APE shares. In fact, buying up billions of APE shares would likely cause the squeeze even faster. AMC has been traded and manipulated for potentially the last 10 years, whereas APE has only been traded and manipulated for about a week. Therefore, I do not think that hedge funds buying up hundreds of millions, if not billions of APE shares is a bad thing. If anything, I think it would be very, very good, as it would certainly cause an APE squeeze. Now, if you are still worried about APE shares being converted into AMC, don't forget this conversion can only take place if an investor vote is taken and is passed. Don't forget, we the retail investors hold 90% if not 95% of the overall APE float, and therefore it's very likely this conversion investor vote would not be passed. And therefore, even though it's not necessarily a bad thing for these hedge funds to create and buy up billions of APE shares, it's likely the vote wouldn't even be passed. Now, I want to touch on the wider market crash, and I want to talk about all of the different funds that are currently blowing up. Adam Aaron tweeted saying, interesting fact, many thousands of people will descend on Nevada's Black Rock Desert starting tomorrow for the annual week-long Burning Man Festival. And as Rico replied, he said Black Rock is burning. Got it. This again seems to be another one of Adam Aaron's cryptic tweets talking about BlackRock and talking about how they're burning. We know that BlackRock recently lost $1 trillion and has also recently halved its AMC position. This could be a sign that BlackRock is indeed struggling and they're having to sell off massive portions of their portfolio to avoid a margin call and avoid bankruptcy. And on top of that, it's not just BlackRock, but it's the SPY as a whole that is currently burning. Options Action tweeted saying a huge crash protection buy took center stage as the SPY traded huge options volume today.
So SPY, the ETF you were just referencing, it traded 1.3 times its average daily put volume. That may not sound like a big increase, but actually that means it traded more than 1 million extra put contracts. In fact, over 13% of all the options traded today were puts on the ETF. And the biggest trade we saw was a purchase of over 45,000 of the September 9th expiration weekly 359 puts. Those are a little bit more than 10% of the money. The buyer paid 34 cents for those. That obviously looks like a bit of crash protection. That kind of event, a decline of over 10% in as many trading days, actually is an exceptionally rare event for the S&P. That happens less than 1% of the time if we look back over the past 90 years or so.
So clearly some very large investors are expecting the entire S&P 500 to crash by up to 10% over literally the next week or two. Now, on top of that, the Fed's Kashkari said, I was not thrilled to see the stock market rally following our most recent Federal Open Committee meeting. And he said he's delighted by the market's reaction to the Jackson Hole speech. And he followed up by saying, I know how serious we are about lowering inflation, and I believe the markets were misinterpreting that at the last FOMC meeting. Clearly, the Fed was very unhappy that the market was rallying over the last few weeks, and they are very happy that the market has again resumed its crash. They're thinking that as the market continues crashing, hopefully this does end up lowering inflation. Typically in the past, previous recessions have done a great job at lowering inflation. Therefore, the Fed is quite literally trying to crash the economy and trying to cause a stock market crash on purpose to reduce inflation. So it seems like it's not just BlackRock that's burning, it's the entire S&P 500 and the market as a whole, and the Fed is very, very happy about this. I think something that's going to add to that crash, as I mentioned in my video earlier, is the new introduction of the Phase 6 requirements. And as Randall Cornett tweeted, he said Phase 6 isn't just a damn fine. People keep saying they'll get a small fine and a slap on the wrist, and this just isn't true. He said they can get hit by a DNT or a do not trade, which essentially cuts off their ability to trade with these larger counterparties. The extract says, unlike MiFID, which saw non-compliance resulting in a possible fine, doing so with UMR Phase 6 could result in trading with some or all counterparties being frozen entirely. Because of this, it's necessary for firms to ensure they meet compliance regulations before it's too late. If many of these funds don't meet these margin requirements and don't meet these phase 6 requirements, they effectively have their trading accounts frozen and they can no longer trade on margin or borrow money from these large banks. They effectively fail these margin calls and they will have to meet those margin calls or face liquidations and do not trade freezes. Obviously, as the market continues crashing and as these phase 6 margin requirements come into place, many of these funds are going to find themselves not meeting these regulations and unable to trade, experiencing margin calls, account freezes, and liquidations. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.